So our goal here is to really help you
Muted.
understand how you can, get focus in the right direction, and then you can start narrowing your focus with exploration. We do that through scanning. I'll give you a little taste of that before we're done. And then ultimately it's about pulling the trigger. I talk to a lot of traders these days who maybe they didn't have a clear system or method on how they were getting into trades, and then they kind of got stuck in some trades, and then they got burned. And so then they got fearful. And so our job is to help you basically say, look, how do we start helping you, train you in the right direction so you can hit that bullseye target and really get focused on that. I think it all starts with having a plan. Let me just ask you a quick question. How many would say that you've got a written trading plan right now that you feel really confident in that doesn't have any holes? Just type a Y or an N. I'm not going to name any names. I'm always just curious to see how many people say they've got it. And actually, a couple right off say they have it, which is surprising, but most of you say you don't. But, definitely that's okay. Don't panic. Know that, that needs to be one of your first focuses, is starting to get narrowed down on exactly what you're going to do, how you're going to get in, how you're going to get out, and a lot more that goes into that, including how much capital you're going to allocate, how you're going to gradually take your profits off the table, where you're going to place your stops. We'll talk about some of those core principles here today. For me, it really gets a lot easier when you start to work with somebody or yourself having a good system. You've got to have a clear technical basis, in my view, if you're going to trade, because the shorter term you get, the more important technical analysis becomes. For me, it's about running tests that show me a clear edge in the markets. Just some quick overview on technical analysis, and then we're going to show you a couple of charts with a couple of clear indicators you can take home today after you're done with all the sessions and start to apply them on your own charts. Obviously, technicals have been around for centuries. For me, I was, fortunate, and I think a lot of us have been fortunate to be around for the computer boom that's allowed us to really use computers to leverage our time and really narrow our focus down here over the last 25 years. That's been really prevalent. Now, as a technician, I don't care just about the news. If you tell me a stock's got good earnings, we know earnings season's coming up, for example, and I think somebody's going to be talking about that. But basically, what I care about is how the stock behaves as the news comes out, in front of the news and after the news. So the reaction coming into and after news is really more important to me. I want to see a stock that's behaving well, going up in the face of and after good news. And sometimes you'll see stocks that have good news, quote-unquote good news, and then they sell off on the earnings. They sell off on that positive news. So you got to be careful on those and say, what's the real reaction? That's what technical analysis helps us to see. And so ultimately we're talking about supply and demand, buyers and sellers. And of course, in the short term, we're talking about fear and greed. You're seeing the markets oscillate faster than ever, it seems like. And I call it the manic depressive market, because you're seeing us now we've run up, then of course yesterday we pulled back after a good jobs data. Again, a not so great reaction to good news. So we want to talk about that and look at those charts. But of course, the three big assumptions of technical analysis is, let's face it, the markets are discounting into the future, typically about 6 to 9 months ahead. That's getting factored into the fundamentals. That's one of the reasons why you see a sell the news phenomenon, because the insiders and smart players have been buying in front of that news, and a lot of times will use the news itself to get out. Now, we believe at Big Trends that price action does occur in trends, because let's face it, everybody doesn't have access to the same information at the exact same time. And so bottom line is that what we see is that as that information starts to gradually come out, you'll start to see that trend start to get established, and then more and more people start to jump on that trend. And while the past may not be exactly repeated in the future, it may rhyme going forward, right, compared to past patterns. We believe that patterns are really where you start to get an edge in the markets. The names will change, I like to say, but the pattern tends to remain the same. So we're talking about bullish patterns and bearish patterns that you can take advantage of, because human beings are the ones who are still at the core acting in the markets. Even with the computers at all of our fingertips, we're the ones programming the machines. So let's face it, we all want less risk and more gain, and how do we get more of that? So bottom line is that for me, I don't find fundamentals that useful as an active trader. I keep in mind things like earnings reactions, which are important in the long term. And yes, valuation eventually could matter, but sometimes a cheap stock can get a lot cheaper. You've seen it. We'll take a look with oil prices and what's happened with oil and the outlook for oil going forward. But the bottom line is that we want to simplify technicals down to key price action, volume, and basically patterns of success to determine those current and future trends. and knowing that the past does tend to repeat or at least rhyme going forward into the future. So as a technician, we're going to use those patterns to help us get in line with new patterns. Now I'm going to give you one indicator that I like to use here. Look at a chart in just a minute, but first I want to mention that what I look for in a trend is I look for what I call confirmation. See, a lot of you are trying to trade that first turn in the markets, and you're getting faked out a lot. And everybody's telling me that the number one goal, we just did an event recently at the start of the year where people said, and Happy New Year, by the way, to everybody. Hope your New Year's off to a good start. It's been volatile for the markets, so it's good for us. That everybody's telling me, two-thirds of people, when I did a poll, said, what's your number one goal? Consistency became the top word that everybody was telling me they're interested in. More consistent results, which of course means probably you're willing to give up some home runs to avoid some strikeouts and start getting on base more, start really having more regular success. And of course, a big part of that is trying to avoid the whipsaws, the fake outs as I call it, rather than the true breakouts. And so the bottom line is that we're looking for a way that we can start to create filters on price action, because some of the traders out there will tell you, you don't need indicators, you should just look at pure price action. Well, guess what? Now more than ever, there's so many fake outs and whipsaws on a day-to-day basis in price action that I believe filters and thus in the form of indicators are very important to find what I call the true trend rather than those little fake out trends in between. So we would watch that first potential turn as what I call a setup, and then I would look for what I call a confirmation, which is the stock or market proving it to me and following through in that same direction. So it's not faking you and then going the other direction. It's following through. Now, you'll give up the very start of a move to get this proof, if you will, this sort of validation. Obviously, there's no guarantees in trading. You're still going to have losses within any method if you don't plan for that. That's just not sensible. You've got to plan for how you can manage your risk, and we're going to talk about how we manage risk with these tools here, big trends. Now, the bottom line is that a setup is an indication a trend could be developing, but that's where people get tempted to rush in. That's where a lot of people are a little too hair trigger thinking, ooh, I'll beat the rest of the crowd to that punch. Well, guess what? A lot of times you'll get faked out instead. And it's because I've seen that these best trends tend to display very similar characteristics and patterns. So talking about specific criteria to find these trends, you can get that confirmation that that trend is really wanting to go. So let me share a chart. We use a variety of different softwares, but we're going to look at TradeStation today. And let me make sure this is coming across. I'm going to just reshare this. And so what I've got here is a long-term chart first. Now, like I said, we're shorter-term traders, but you still want to know the direction of the longer-term trend. And you can see this goes, we can go back as much as we want, but let's look at the recent signal that we had, and then we'll look back at a little bit of quick history for you, give you a little history lesson to get started. Because as they say, if you don't know the lessons of history, you're bound to make mistakes that you could have learned from past history. So the bottom line is, what is this indicator on the bottom? This is the big trends approach to Larry Williams' indicator known as percent R, or the percent range indicator. And what is percent R typically tracking? It's basically saying, if you were at this point right here at the end of 2010, just for a quick look back, you would say, okay, well then percent range would say you were basically getting your highest print on the last, in this case, basically 2.5 years on a monthly chart. That was at 11,625. You can see the low over that same period was down just under 6,500. So you can see that you had a range of just over 5,000 points. And so what that means to me is that, okay, guess what? If you're closing right near the top of that range, which we were very close to, we didn't quite close at the top, but you can see we hit the 94.6 percentile, so almost in the top 5% of readings at the close at the end of 2010. Now, most people would say, okay, that's quote-unquote overbought, right? But what I found through literally the first years of my trading experience in the early 90s, fresh out of Duke University, graduated from there, frankly thought I knew it all after reading a few trading books, and made some early mistakes because I thought, well, overbought is supposed to be bad, so we can go and short that, right? Wrong. Bottom line is that I learned some of those lessons the hard way, and so now what I teach all of the folks about big trends, having then now tested it extensively, is that actually when you go overbought, yes, it may be the top of that trading range if it can't keep going. This would be that setup I was just talking about. If we close, though, over that 11,625 number, there it is the next month. This is a monthly chart. We'll go down into the shorter-term charts in a few, but that's a close above that number, 11,891. So that's why I was giving us a buy on the next bar's open. Okay, so we got a buy signal around 11,900. You see that we started to rally, and then you see that actually we were wrong for a little bit initially on this signal, where %R came back underneath the oversold level, that top 20% of readings. It actually came back underneath it right there in September. Remember what happened there in the summer of 2011? That was where we had a debt downgrade for U.S. debt, and basically people were really panicked about that. And guess what? This is what I call a retest. When you come out, one of the reasons I love the %R as an overbought, oversold indicator to use in this very unique, unconventional way is because it's more jagged than, say, your typical stochastic or even RSI, overbought, oversold oscillator. And so what I found is that when it has that little brief snap down under that overbought level, that's what I call a retest. The retest means if this trend's not going to hold, that low is going to get violated on a future close, not intraday or interbar, but on a future close. So we were just under 10,600. You see we briefly traded underneath it at the beginning of October. And then the snapback off of those retests can be really powerful. In fact, that October rally that year was the biggest one-month gain in the Dow going back to January of 1987. Okay, so you're talking about a really powerful snapback. So this is kind of like the coiled spring analogy. You get that pressure, where the short-term players are bailing out, but the longer-term outlook here is bullish, and this trend can still hold as long as it doesn't close under that low. If it closes under that low, we get an exit signal and we get out. So you see what happened. We get a snapback rally to new highs. Then you get another retest as we test back under that overbought threshold back in May of 2012. And the interesting thing is, while %R picks up the closes, during the month, like you remember what happened this past October, we had that incredible spike down to under 16,000. And guess what? That was a retest as it popped down to about 16,400, I recall, because basically we had a high of the range at about 17,350 from the prior month, and then going back about 2.5 years, you had a low back in here mid-2012 at about 12,000. So you had about another 5,000 point range. So guess what? When you come down from 17,350 high to 16,350, which happened to be around this trailing 10-month moving average here, 16,350 is telling you that's a pretty good spot to buy. You're wrong initially for a little bit as it pops down with that little panic we had in early to mid-October down just under 16,000, and then the big snap back up and rallied back up to 18,100. You can see right now we're sitting about the 93 percentile. How is it, we get the question, how is it that something can stay overbought for this long? That's almost defies gravity, doesn't it? But remember, the name of the indicator is percent range. Is this a trading range? No, you can see it's continuing to go up, up, and away. And you can go back over time and look at multiple examples of this on the upside, like the bull run from the beginning of 04 to the beginning of 08. You can see as it violated, snapped down at the end of January of 08, that was a violation of a prior retest and told you to hop out of that bull trend, 12,636. And guess what? You can see now as we go oversold in the bottom 20% of readings, there's the oversold first setup right there in June of 08. 11,287. I was actually on Fox News at the beginning of September, and I said, watch out below. We were just having a bad jobs report, and I said, our indicators say that this market is headed for a lot more pain. All three of the other panelists disagreed with me and said what a great buying opportunity it was. And that's usually when I really feel good about the fact that most people are backwards looking. Most people are saying, ooh, I'd love to buy that dip in this multi-year uptrend. Guess what? The market structure says you're in danger zone there in fall of 08. Tells you to get short at 10,847 on the Dow. And you see the Dow, of course, drops more than 4,000 points over the next 5 months. So the point here is that, you can take advantage of these. By the way, this data on TradeStation for the Dow goes all the way back 90 years. It actually gives you data back into the 1920s and 1930s. You can see, actually, we didn't quite have enough data to start tracking it now until about the late 20s, but you can see we were overbought. There's a retest, and then, of course, the big monster roaring 20s rally, and then, of course, the crash of 29. What I think is really interesting about this, let me reshare my screen, make sure you can see it okay. What I think is really interesting about this chart, you hear about the Great Depression, right? Guess what? It didn't happen based on technical indications from the crash of 29. In fact, that was technically a retest. We saw the same thing in 1987. The 87 low held, but you can see the difference here is that low, and then of course the subsequent breakdown into the oversold territory and following through told you that we were in a new short signal a year after the October 29 crash, October 1930. So historically, the real problem for the Great Depression happened not because of the 29 crash, but because of the downside follow-through a year later, October 1930, sell in the Dow at 205. That's hard to believe, isn't it? The Dow's now at 17,737. But the point I want you to realize is think in percentage terms. The yellow line's just a 10-bar average there, Ramesh, 10-month average in this case on a monthly chart. So the point here is that you can use this, of course, and we'll show you short-term too. Big picture quickly is sell at 205.92. You know that the Dow hit that all-time low for about the last century here, down at 40.56. That's a 80% haircut, right? And of course, by the time it comes out of the oversold and then it violates that oversold bar's high, that's the exit officially at 88.11. Still from 200, that's still more than a 50% haircut on that short signal. That's very profitable, obviously, for bears. What's interesting, of course, is everybody probably swore off stocks after all that leverage and the deleveraging that was happening there. And then guess what? You got another buy signal to start in 1935 at 104. And look, that ran to almost 200 for a near doubler to 195. So the point of this is that you have opportunities in a lot of different market environments. So my point is, we've got bear moves and we've got bull trends in the big picture. You can see my outlook for 2015 is still bullish as long as we keep holding those retests. We can still pull back along the way, but in the big picture, I'm a bull. Okay, so now we're going to also talk about not just stock charts. We're going to also talk about option charts. I assume a lot of the traders with us are not just trying to figure out stocks, but also trying to figure out where they've got options opportunities. That's a lot of what we do at Big Trends, because I say, hey, if I can find the right kind of trends in a stock, why shouldn't I leverage it with an option, assuming I can do so intelligently, and that's what we want to help share with you here today. So the point here is that I am still amazed. I've been talking about option charts for about 15 years now, 14 years, so about a year after I launched Big Trends, I stumbled across this concept because a lot of the brokers started allowing you to plot an option chart. And so the idea here is, I've even had option strategists who are very well known tell me, why are you even bothering to look at an option chart? Isn't that the same as the stock chart? It's just a derivative of the stock. Well, guess what? There's a big difference between options and stocks, and you probably know what those differences are, a couple of them. One is that, of course, options are time-limited assets, that time decay that happens in an option is something you've got to overcome. One of my strategies initially for trading options was just buying more in the money options that don't have so much time risk. But now I can even look at the money or out of the money options and tell if the trend is strong enough to overcome the loss of time. If it is, then you want to buy the option. If it's not, you want to be an option seller or consider spread strategies. I know somebody's going to talk today about credit spreads. So the other element, of course, as you know, is volatility. If you've got a volatile stock, as long as you can stay on that bucking bronco, if you will, you can still ride out that volatility as a stock. If you've got a volatile stock that's going nowhere as an option trade, that can be very, very costly in terms of the decay that's happening because you're paying up for the right to trade that more volatile stock in an option. And most people think, well, then I'll sell those options. Well, guess what? If it's too volatile the wrong direction, you can get flushed out of your spread or what have you. So we've got to find ways to manage that. So the option chart really helps me to focus on these kind of opportunities, and basically, we really look for, situations here in which you say, okay, look, that if a stock stays flat or just basically chops around and goes nowhere here, what's going to happen to the option chart? Your option chart, especially if it's an at the money or out of the money option chart, is going to end up doing one of these. It's going to end up kind of just wiggling downward because the time loss will eat it up, right? So one strategy to mute that is buy that what I call in the money or ITM option. So that's one way you can think about it. But another way is to look at the option chart. So let's show you an example. A good example as we go, maybe look at a daily chart here for a second, would be, of course, everybody asking about Apple, right? So let's take a look here at Apple for a second. Okay, we use a variety of indicators. Percent R is kind of the starting point. So you see, for example, Apple had that big breakout after earnings on this chart back here. Remember I said the reaction to earnings? Well, the reaction was good. The stock had a nice gap up, and it held that. And then, more importantly, as it went over bought right there, let's zoom in on that. You can see it goes over bottom %R. We've got other tools here like my acceleration bands, which is pretty much how I launch big trends. The CCI, the Commodity Channel Index, the directional movement lines on the bottom panel. And so got a lot going on here, obviously, and so this is one of those things you learn from big trends over time. So, but focus, if you're just trying to focus on one thing, start with %R. So %R says we're overbought, high of 103.02. It doesn't close above there the next day, but it's still staying overbought. So we still keep that 103.02 active, and then we get the confirmation as it closes above there at 104.83. Now, a lot of people will tell me, well, price, that you're late on that chart. It's already run from a low at 95 to now you're telling me to buy it at 105.18. And I'm saying, well, look, that's a catalyst. It's a follow-through. And look, that move is happening now from 105 up to a peak at 119.75, up about 15 points. And then, of course, it had, like, to start off December, this little kind of slam down, almost like a flash crash intraday, popped down early as we kicked off December. That was the retest, and you can see that sell took a little while to violate that low because it was a bit of a volatile low. But you should be taking partial profits along the way. If you were looking at, let's look at a January option chart. If you're looking at this isn't TradeStation, but a lot of brokers do now have this. Had a question in there. Chris said a lot of brokers don't have it. A lot do, Chris. So not just at TradeStation, but a lot of the others. But bottom line is, let's say that when you're getting that buy at 105, let's say you were looking at the January 105 at the money call for starters. And remember, that buy was happening as we just went over bought here and followed through. So that was happening in this neighborhood at the end of October here. You see the option's about $4.80. So now we're plotting the option chart. Now, realize you should be only looking at an option chart if it's reasonably active. So I tend to reserve this option chart analysis for really the top tier, most active and liquid names. But what you see happening here is just like the stock, and interestingly enough, we almost had a little retest in the option. It got down to about 81.5% as it sort of pulled back right in here, and even may have retested there intraday on a couple of those lows down around 5.5. But the point is, see how it's breaking out of these acceleration bands, breaking out of the %R, overbought on the CCI, nice ADX trend there, that green line on the bottom. A lot of good things happening on that chart. Now, my point would be, let's say you bought it for, let's just say back here we were looking at 480, call it $5. Okay, so the point here is, say you bought it for $5, which it was still trading at 5 over the next couple of sessions. My rule of thumb is, if you see it go from 5 to 10, it's foolish if you don't take half of your money off the table at a double. If you're still riding and you've got a chance to take a double on half your position, what does that do for you psychologically? It gets you to be able to book your risk capital back to into your pocket, into your bank account, and that you still got half of your position on, and this thing then goes from 10 to 15, right? So, and again, from 5 to 10, then 5 to 15, it's a double and then a triple, and another from 100% to 200%, I consider taking another piece off, and then of course this one then spikes down here as you got that sharp pullback in the stock from 119 to 111 intraday, and of course then violating a little bit later. But the point is that if you're gradually taking profits out as the market makes them available to you, it's a really sound strategy. So you can use, and you can see right now, would I do anything with Apple? Not really. It hung a little bit better than most. But actually it's on a slightly bearish trend, and that high 740 from the day before actually held at yesterday's close. So right now the DMI lines are a little bit net negative too. So I would basically say I'm not interested in Apple calls. At the same time, if you look at Apple puts, if we flipped it around at the same time that when the stock was breaking out on the 105 put, let's just look at, this is a January 105 option. These expired this next Friday. I'm not recommending either of these, just showing you what those options look like. You can see, of course, when the stock was going up, up, and away, guess what's happening to the put? It's going down, down, down. And, of course, if you're an option seller, you're a credit spread trader, what have you, might be looking at put credit spreads as a net bullish strategy, neutral to bullish. And so you can see that one has been edging down. But the point is it'll show you where the trend is, up or down or sideways, in the option chart and which way you want to consider going. So it really helps you to start looking at different strike prices, different types of options along the way. You can see with TradeStation, and we've got our toolkits available across several platforms, TradeStation, Thinkorswim, Metastock. you know, to name some. But bottom line is that, you know, my job is a lot easier if I've got a really specific buy signal and a really specific sell signal or exit signal. So when I can just focus on following the rules of the system, and then when it says buy, I buy. I don't ask questions. When it says sell, I sell. The only thing that's maybe a caveat to that is we've got earnings season coming up. I tend not to buy right in front of earnings if it's the day before earnings. If I've got a week before earnings, I might be able to buy and get a piece of that move and get out at least a part or get my risk capital back before the earnings hits. But if I don't have time to let that move play out, I'll probably pass on just before earnings signals, because you don't want to have big gaps. You know, big gaps for you are fun, but big gaps against you are no fun. So we tend to say that's the only time that we would avoid that. Now, Bobby asks, is this like a black box? Well, actually, we teach you all about it. I'll tell you about that in just a minute. Now, one thing I meant to share it on the Dow system, on the long-term Dow, but it's a good reminder for me to show you. You know, we put all of our various big trends methods through a lot of testing. This is a chart of Apple from TradeStation going back 20 years, 92 to 2012 as an example of, okay, you can see you did pre-split. It's obviously had a 7-for-1 split since then, but pre-split you can see that, you know, Apple was really good on your longs and really not so great on your shorts, right? So that was pretty, you know, probably pretty obvious to most people, but the bottom line is that it pretty much tells you where you have an edge. Remember I showed you this Dow system here. Let me go back to that for a second, this long-term Dow system on the %R. Within TradeStation, if you go to View Strategy Performance Report and you pop up that performance report for the Dow, this goes back 90 years, remember, and this isn't, it'd probably be even more clear if it was in percentages, but what really opened my eyes, this assumes if you bought 100 shares of the Dow, which of course you can't do, you could buy the DIA, but it shows you, you know, how we haven't had a lot of signals over 90 years. You can see 16 longs, only 7 shorts. It's been right 5 of 7 times on shorts. It's been right 9 of 16 times on longs. But the other element you want to look at down here is this one, the size of the average winner to the size of average loser. This is absolutely insane how strong this is. 24 times the size of the average win to the size of the average loss. That's mind-boggling. Now, of course, because you're able to ride trends that work and get rid of trends that don't quickly, that's the secret of trend following success. Even on shorts, the shorts are right 8 times more than they're wrong. Combined with the 71% win percentage, that's phenomenal. When you consider you've had a 90-year overall bullish environment, you saw that my first signal we had was back with the Dow at about 200. So the Dow's up some 100 or 90 times that, right, since that point. And yet the shorts have made you money. Now, this is not a guarantee on dollars. This is more of a guide to what I like to look at is the performance graph history. You know, what's your equity curve look like? And you can see it wasn't perfectly straight up. You can see that you had a couple of give backs in the 70s. That was a choppy period from the 70s to the early 80s. And, of course, the biggest signal was a signal from the beginning of the 90s into the end of the 90s. So if you go back a little bit in time, let me scroll back just a second and show you that chart. The point of this is that shows you the power of the %R methodology from 91 to the end of 2000s, where it told you to hop out before the 2000 to 2002 bear correction there. So the point is that we're looking at these breakouts. The multiple retests give us the opportunities along the way to buy back in, to tighten our stops. And again, now we can take this same approach, and we're going to talk about it on a short-term basis. Now, how do I find? We talked about that Apple option chart, right? But let's go for a second and look at how I find new trades, like with %R. So this is something that you can get as part of our toolkits, but I'm going to focus you today on more education and how we can get you started understanding how to find these opportunities through the right education. Now you can see A to Z, I've got probably 150 key stocks in here, but what I'll do is I'll take my %R scan, so the bull scan, this is showing a 15-minute chart. So if you really wanted a short-term quick trade, you could use the 15-minute chart, and you could say, well, what was really strong? Well, actually, bonds were getting strong again at the end of the day. These are not recommendations, but bottom line is this is how I build my watch list. That's kind of interesting that you've got Cheniere Energy, which is a liquefied natural gas play, starting to heat up late in the day. So not much was that strong. On the bear side, obviously, there was more bears that were breaking down at the bottom 20% of readings, including some of the financials, COF, Wells Fargo. You look for patterns, right? MasterCard, you see a lot of those names starting to break down. That's on a 15-minute chart. You can do the same thing for any time frame. If you're a swing trader, a lot of you I know are swing traders, I would change it to a 60-minute chart, and then I would resort my my various ones. Karen says, do I prefer a 15-minute chart over a 5-minute chart? Yes, absolutely. 5-minute chart to me is too noisy. It's hard to make it work with trend following methods because you're going to get whipsawed too much. It seems appealing to look at shorter and shorter term charts, but not if they're going to whipsaw you out of the trade. So if you look at your strongest names on your hourly charts, look at what's at the top of the list. The top 4, AEM, Agnico Eagle, you've got GOLD, which is Rand Gold, GDX, which is the gold mining stocks ETF, and then Newmont Mining gold stock. All top 4 are very powerfully bullish. So gold, of course, has been roaring. So what I'll do, for example, we'd recommended AEM the week before to our, let me just shrink that down a little bit. We'd recommended it to our workshop students. We've got all kinds of ways you can learn this here at Big Trends. So if you look at AEM for a second, at the top of the list, and you can see I'm clicking on it, and then it's automatically pulling everything up. You see that a week ago it's just starting to break out on the daily chart. You see we got a fresh new hourly buy signal here Friday morning as it broke out and then followed through after the jobs data. So that was a buy signal there at, you can see that next bar's open, which is 29.24, and it ended up rallying to about 60 cents, maybe 54 cents actually at the close, and it was even indicated even higher after hours. And you can see the breakout happening on the 15-minute chart here. So we're getting the nice surge on those short-term as well as those intermediate-term panels. So then you would go and you see if it's around 30, while I wouldn't necessarily trade the 30 stock, I would look at the options chart for, say, the 30 call and say, was that looking like that the trend players were winning the war against the time? And you see that they were back earlier in the week. You had a nice little breakout, a nice kind of a day surge there back on January 6th. You can see right now it's kind of a crunch time on the hourly chart. Percent R is not quite where it needs to be, frankly. So I'd be watching it, but I'd probably be looking for a little bit more follow-through to tell me that we're really piling on now for the gold trend. It's not quite where I want to see it. Now, we're going to come back and look at a couple more of these charts here in a second, but I want to remind you that how, because we're getting questions about, okay, do I just keep all this for myself and then make you pay for the trades? No, I give you the opportunity to learn how to do this yourself too. So this is a pretty cool special because it's actually not just one course. It's actually 3 different training sessions that I got on 3 different DVDs that I call my Trade Secrets course. So bottom line is that you start to learn these strategies like percent R, like the CCI and the acceleration bands, these various ones that really help me put Big Trends on the map, help me to grow my results to actually launch Big Trends, and then ultimately start sharing this out with many thousands of traders over the last 15 years. You would think that if it's been shared out over that long that it would stop working, wouldn't you? But actually, we keep retesting it, and it keeps on testing really, really strongly because there's still more and more traders that believe that overbought is bad and oversold is good. And I believe that's a mistake based on the testing. Okay, can you use Thinkorswim? Says Mike. Absolutely. Thinkorswim is one of our brokers where we have our toolkit on Thinkorswim. And if you're interested in the toolkit, you can send us an email here through Big Trends, and we can get you more information on that. But let me just share with you real quickly. If you went to that page at bigtrends.com/trade secrets, what you're going to see real quick. And then I'm going to come back and pick up a few more questions and show you a couple more charts before I hand it off to our next presenter. But, because we got a really tight time schedule to get all these great content presenters in today. But bottom line is, when you go to that page, let me reshare it real quick, bigtrends.com/trade secrets, and thanks, Reed, for posting that. Bottom line is that it's 3 courses, it's 5 hours of training, and it's $49 with free shipping anywhere in the U.S., okay? Pretty insane value. Now, the 3 pieces, you see automate your option trading is the first one here, okay? So the automate part, a lot of you are still trying to kind of do a lot of this yourself without using the power of computers, the power of scanning, the power of how you can start really letting that do a lot of work for you and start getting you focused on really the top few percent of ideas that you really should be looking at. You know, if you're trying to scan through hundreds of stocks a day, or even if you're just looking at one or two things a day, you might be missing opportunities. This will really help you leverage the technology side and start getting you focused on that. Plus, it really helps you start understanding some of the other areas where you can focus on some simple rules to start cutting your losses and letting your winners run. Now, you heard me talking about option charts. I've got a whole DVD here that's devoted to using option charts to boost your trading profits over time. Again, there's going to be winners, there's going to be losers. The secret of the game is cutting those losers and letting those winners run. But you've got to be on the right profile of option charts, in my view, in order to help you really take advantage of this. So it shows you how you can screen out a lot of the noise. Frankly, I think this word noise is what most traders are having the hardest time with. You're getting so much information overload that you're really getting yourself in a position where you don't know what to do because you've got too many things coming at you. Some are yelling bullish, some are yelling bearish, some are yelling just stay out. And so you end up doing nothing because you've got too many different noisy folks or indicators or TV folks shouting at you. And the bottom line is that you've got to focus on what's really going to drive you. Now, the option charts is very powerful. Now, the 7 golden rules for option trading success really goes into a little bit more focus on the psychology, what I would call the top 10 problems that every trader faces. Whether you trade stocks, options, futures, Forex, you can benefit from this. Just because it says options, you can benefit from this as a trader of any type of market because all those psychological elements and challenges are what we face as traders every day. You've got to have strategies to help you push through those. So we call this our Trade Secrets Library, and today, as part of the Investor Inspiration special, we wanted to give this to you, all 3 for just $49. If you just wanted one, you could click on one of those links for $25 a piece. But of course, the best special is all 3 of them for $49. And you can see, you just add that to your cart, go through and put your key information in there, and you'll be good to go. The retail value on these, you can see 75, 60, and 60, $195 retail. So we're saving you about 75% off here today to get your new year started off right. Now let me go back, and that's at bigtrends.com/trade secrets. Let me go back and just remind you a couple other things here. Of course, we talk about all these key topics. How to get the market right. So market timing is important. Anybody that tells you that market timing doesn't work either can't do it or doesn't, like your fund companies, they have a big campaign. They don't want you to try to time out of your funds because it creates more work for them and might risk you moving your business somewhere else, right? So they want you to just sit. But bottom line is that I think if you sit still, you're basically potentially going to get run over by those who are moving past you. And so, you know, I'll share with you my favorite ETF system, these top technical indicators, as well as the best option strategies for any market. Obviously, there's different option strategies that work better in up markets, down markets, or sideways markets, and you can then follow up if you've got any questions. We give you a dedicated email. Leveraging technical analysis is all about getting multiple time frames in your favor. So part of what I was just showing you before, like with the Agnico Eagle example, we'll come back and look at that. I said if you got all 3 time frames working in your favor, the 15-minute chart for me is the day trader time frame, 1 to no more than 2 days. The 60-minute chart is more like a 1 week, 3 to 5 days swing trader time frame, and the daily chart is more of a position trader time frame. If I get all those boxes checked, 1, 2, and 3, then basically I'm going to increase, and obviously if I've got the long-term trend working for me as well, the more of those time frames I get working for me, the better, right? So the bottom line here is, like, when you go back and you look at AEM, you got that confirmation about 4 days ago, back here officially at the close of the 5th, so the morning of the 6th, it was saying buy at 27.50. You can see the hourly chart on a buy, 15-minute chart was on a buy at the start of that morning, right? So it picked up all 3 of those catching that run, and then you can see the 15-minute told you to hop out here briefly. And you see how it tries to go back to overbought, and then it fails on the 15-minute chart. So you're actually waiting for the next couple of days, even tried to give a short. Look at that, try to give a short. Would I be taking a short on a 15-minute chart when the daily chart and even the hourly chart were hanging in there? No, you don't want to go against the longer-term trends. You want to line yourself up for the opportunity to really take advantage of these strong trends. So the bottom line is, if there's one idea you can take home from my sharing with you today, it's, okay, focus on, first of all, getting the percent R right. So you see there's multiple indicators on here. You'll learn all that through the DVD special. But for taking a take-home today, focus on percent R. And I'm going to give you this setting here. You see it here. It's a 30-bar setting. That's going to be different than what most platforms will default to. Most of platforms will default to a 10 or a 14-bar percent R, kind of like what Mr. Williams originally was using, a real short-term kind of overbought, oversold oscillator. But if you use a 10-bar percent R, for example, you'll see it's jumping all over the place, and you'll need a neck brace with all the potential whiplash that you'll get from the back and forth whipping of that indicator. But when we smooth it out over 30 bars, in my experience, that served me well. You can see, like on the hourly chart here, zoom in a little bit, when you catch that breakout, you see then that it comes back and it gives you what we call that retest right here. If you miss the first wave up, how many times, folks, have you missed that first leg up and you're on the outside looking in, and then you're saying, well, now what do I do? I guess I'll just have to watch because I missed my opportunity to get in here at the first hourly buy, 25.98. Well, you see when it gives us this retest, that retest low in here is 26.28, and it's closing that bar at 26.59. So say you're buying there at the next bar's open here at 26.60. You know your stop now in the hourly chart is an hourly close under that retest low, 26.28. So can you handle taking about 40 cents of risk? So you say, okay, 40 cents of risk, and it goes from 26.60, and the next morning it's up at 29.53. Almost a 3-point rally, $2.93, right? $2.93, and of course, by the time, say, the hourly got you out, it's at 28.36. So you say, okay, let's just be official. From your reentry, you're up only $1.86. If you were risking 40 cents to make $1.86, you can see that's got a reward to risk of more than 4 to 1. That's how you have to think about your trading is, can I take this risk? And if you say, well, gee, trading my normal size, it might be too much risk. If I trade my half my size, maybe you can handle that risk. Scale down the trade to the right risk. Trade it in paper on a number of these platforms or simulated trades at first to get comfortable with it, and watch these and see what you're missing. It's powerful stuff. So that's why I want to make sure that I focus you on, if that take home, change your setting to the 30 bar. You'll see it listed on a lot of platforms as Williams percent R or P for percent range, and the bottom line is, you can see I use a 0 to 100, positive 100, what I call the grade school scale. We're looking for A or A plus type of stocks and situations. You'll see on a lot of the platforms it'll be Larry Williams' initial 0 to minus 100 setting. You can still use that. You just need to look for the top 20% of readings when you're talking about these unique situations. So the bottom line is, that's how you can take advantage of that. And when you get them what I call triple confirmed, dailies a buy, hourly's a buy, 15 minutes a buy, that's powerful stuff. So I'm not recommending that, but I'm saying that's the kind of stuff you want to take advantage of here. So like I said, quickly to just recap, and then I'll hand it back over to Reed, if you go to bigtrends.com/trade secrets, you'll learn how to do this stuff yourself, and literally trying to sort of what I've tried to jam 25 years into about a 45-minute window is tough to do. So, obviously this is the way to continue your big trends education if you're looking to catch more of those meaningful trends and learn these indicators like the acceleration bands, percent R, CCI, DMI, directional movement lines, and more. This will really help take you to what I consider true mastery. A big part of all my training is that I don't just touch on technical indicators. I get into these areas like trade psychology, like money management, capital allocation, option strategies. A lot of this goes back to you learn this stuff, and then you know yourself what you're looking for across this pattern. So like I said, the best way to go here is go to bigtrends.com/trade secrets. When you go to that page, you'll see that you get a lot for just $49. You get 3 courses. These are 3 distinct DVDs. These are actual hard DVDs that you can plug in to your TV, your computer, what have you, that can play a DVD, and then you've got it for life, and you can watch it as many times as you want. And so like we show below, as you scroll down that page, you'll see all the goodies you get. Each one of these is tabbed, so you can see all the outline of all the 3 courses. Like I said, $195 value is yours today for just $49. When you hit the Add to Cart button, just go through. It automatically defaults to that. And like I said, it's free shipping here in the U.S. If you're outside the U.S., we've got to basically cover at least part of our shipping charge. So it's a small charge if you're outside the U.S. But in the U.S., free shipping. and you put your key information in there. You got your key credit cards that we take, and then of course you can see here, you can just put that you saw it here on the webinar today. And bottom line is that we just ask you to review our terms and conditions, which we're very clear about here at Big Trends through the bigtrends.com/terms and conditions link that's right there, first line in green. Once you've reviewed that, check on the terms and conditions box, submit order, you'll be good to go, okay? So bottom line is I want to help us stay on time, so do want to hand it back over to Reed. I want to thank you all for being with us today. Stay with us throughout the day because you've got a ton of great speakers that you want to focus on. So hand it back to you, Reed. Trade well, everybody. Have a very happy and prosperous 2015, and let us know if you have any questions from our special offer. Take care. All that for the 3 DVDs, just $49. And thanks so much, Reed, for hosting today.